So, let me ask you a question. When you hear the words transfer pricing, what instantly pops into your head? You're probably thinking about international borders, foreign subsidiaries, and massive multinational corporations, right? Well, if that's the only place you're looking, you might be overlooking a massive domestic compliance requirement right in your own backyard. Do your domestic intergroup transactions cross the transfer pricing radar? Because if you aren't absolutely sure, your company or your clients might be at serious risk of strict scrutiny under the new tax laws. So let's dive right into this and figure it out. Hello and welcome to This Explainer. Today, we are unpacking an absolutely critical provision of the brand new Income Tax Act 2025, Section 164. This section deals entirely with the meaning of a specified domestic transaction, or SDT. We're going to dissect the statute itself, we'll look at the newly updated income tax rules for 2026, and we'll even explore official guidance notes to make sure you have a complete, practical understanding of how to keep everything compliant. Here is our quick roadmap for today. We'll cover 1. Understanding Section 164. 2. Key components and thresholds. 3. A real-life taxation example. 4. Documentation and filing. 5. Common practical issues. And 6. A summary. All right, let's jump straight into Part 1, understanding Section 164, specifically its objective and applicability. The core objective here is so important to grasp. What exactly is a specified domestic transaction, or SDT? Basically, it refers to specific domestic transactions between associated enterprises, and the law says these transactions must be recorded having regard to the arm's length price, or ALP, which is defined over in Section 173A. Why? Well, the goal is pretty straightforward. Tax authorities are looking to prevent profit shifting within the country. Think about it. They don't want a business shifting profits from a fully taxable domestic unit over to a tax-exempt unit within the same corporate group just to artificially lower their overall tax burden. By mandating an arm's length price, the law ensures these transactions reflect true, fair market value, exactly as if they were conducted between entirely unrelated parties. Now, for the seasoned chartered accountants and tax professionals joining us, this is going to feel pretty familiar. Under the old Income Tax Act of 1961, you knew this whole concept as Section 92BA. Well, under the new Income Tax Act of 2025, it's just been rehoused. Section 164 is the direct statutory successor to 92BA. The foundational principles? They remain exactly the same. But as we'll see in a minute, the compliance framework built around it has definitely evolved. Let's move into Part 2. Key components and thresholds. Let's deconstruct this legal provision. Section 164 explicitly lists out the types of transactions it covers. It casts a pretty wide net. It sweeps in transactions referred to in Section 122, transfers of goods or services under Section 140, subsection 9, and business transacted under Section 140, subsection 13. It also includes transactions under Chapter 8 or Section 144, and business between persons under Section 205, subsection 4. In plain English, if your related entities are doing business with each other, especially if one of them is enjoying a tax holiday or a preferential tax rate under these specific sections, you need to be paying close attention. But hey, don't panic. The law doesn't want to bury every single small business under heavy transfer pricing documentation.
And that brings us to this absolutely crucial number, 20 crore rupees. Section 164 only gets triggered if the aggregate value of all these specified domestic transactions entered into by the assessee in a tax year exceeds 20 crore rupees. So if you're sitting at 19 crores, you're outside the mandatory scope of the specific provision. You can breathe easy. But the second you cross that 20 crore line, boom, full transfer pricing compliance kicks in.
Let's make this concrete with Part 3, a real-life taxation example to show exactly how we calculate this aggregate threshold. This is a classic trap that catches people off guard. Let's imagine an assessee transfers goods to their related company A worth 12 crore rupees. Then they provide services to related company B worth 10 crore rupees. Looking at these individually, you might naturally think, well, 12 is less than 20 and 10 is less than 20, so we're totally safe. Right? Wrong. Remember, the law says aggregate. You have to combine them. 12 plus 10 gives us a total aggregate of 22 crore rupees for the tax year. Because that 22 crores exceeds the 20 crore threshold, Section 164 is fully triggered for all of these transactions. You now have to step up and prove they were conducted at an arm's length price. Which brings us to Part 4, documentation and filing requirements. Let's look at compliance under the Income Tax Rules 2026. The compliance workflow is highly structured now. Step 1, you absolutely must maintain robust documentation as prescribed under Rule 84 of the Income Tax Rules 2026. We're talking detailed records of your ownership structure, business descriptions, and economic analyses. Step 2 is determining your actual arm's length price using the prescribed methods. Then we hit Step 3, which introduces a slick, modernized digital tracking element from the official guidance notes. You have to generate a DAEID. That stands for Domestic Associated Enterprise ID. It's a unique, system-generated identifier based entirely on the information you provide about your associated enterprise. Finally, Step 4, you take all of this and accurately report these transactions in Part D of the relevant transfer pricing form.
Now, there is some serious relief built into the rules. Let's talk about safe harbor provisions under Rules 95 to 98. If you operate in certain specific sectors, the government has provided predefined margins or prices that they will just accept without dragging you through a detailed transfer pricing audit. Eligible SSEs can file Form 49 to opt into this for eligible specified domestic transactions, or ESDT. The classic examples laid out in the rules include government companies engaged in the supply or wheeling of electricity, or cooperative societies procuring milk and milk products from their members. If you fit into these specific categories, Form 49 is literally your best friend for simplifying compliance.
But listen, missing deadlines in tax law is never, ever a good idea. Here are the critical timelines you need to map out. If you are opting for safe harbor, Form 49 has to be filed on or before the due date for furnishing your return of income under Section 263, Subsection 1, Clause C. If you are claiming deductions that require Form 5, that must be filed 1 month prior to your return due date. And if you are utilizing Form 46 to exercise an option for multiple years in a single proceeding, that's due by the 30th of June succeeding the third tax year. Get these dates on your compliance calendars for sure.
All right, on to Part 5, Common Practical Issues. Let's clear up some pitfalls and clarifications.
These are the absolute most common mistakes to avoid. First up, failing to report secondary adjustments. The FAQs are explicitly clear on this. Reporting isn't just for primary transfer pricing cases. Secondary adjustments absolutely must be reported too. Second, messing up the DAE IDs. Because this is a system-generated unique ID, inconsistent data entry can cause major e-filing headaches down the line. Third, and please don't miss this one, you cannot claim safe harbor if your associated enterprise is located in a country or territory notified as a no-tax or low-tax jurisdiction. Just not allowed. And finally, simple administrative errors, like forgetting to use the provided drop-down menus to map the correct transaction type, can literally flag your return for unnecessary scrutiny. Now, to give you a little peace of mind regarding the e-filing portal, Guidance Note FAQ 26 is incredibly helpful in clarifying how the system handles the heavy lifting. It officially states, once the arm's length price has been determined, the rows pertaining to amount of adjustment and Part C/D of the form shall be auto-populated. This is great news. It means that if you get your base calculations right, the system will automatically compute the adjustment required to align your book value with the arm's length price. Let's bring it all together with Part 6, Key Takeaways and Summary, Section 164 in a nutshell. If you remember nothing else from this explainer, remember these 5 golden rules. Number 1, Section 164 of the 2025 Act is your new baseline, replacing the old Section 92BA. 2, this compliance burden is only triggered when your aggregate specified domestic transactions exceed 20 crore rupees. 3, the ultimate mandate here is that these transactions absolutely must be conducted at an arm's length price to prevent domestic profit shifting. 4, maintaining robust contemporaneous documentation under Rule 84 is 100% mandatory. You cannot skip it. And 5, definitely utilize tools like Form 49 for safe harbors if your industry qualifies, because it can drastically reduce your compliance friction. So the big question you need to ask yourself today is this. If the tax authorities came knocking tomorrow, are your domestic transactions fully documented, compliant, and completely defensible? Think about it. Thank you for watching. Please like, subscribe, and share. Disclaimer, this explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational explainer.